The Indian stock market is facing a rough patch. After reaching record highs last year, the market has been on a downward trend in recent weeks. The Sensex and Nifty 50, India's benchmark indices, have experienced significant drops. This decline has left many investors worried. What is causing this sudden downturn? A combination of global and domestic factors is contributing to the current market sentiment. The Sensex, representing the Bombay Stock Exchange, has plummeted by over 800 points. Similarly, the Nifty 50, reflecting the performance of the top 50 companies on the National Stock Exchange, has also witnessed a sharp decline. These drops are significant and indicate a loss of investor confidence in the market. This downturn comes after a period of sustained growth in the Indian stock market. Factors like strong corporate earnings and a favorable economic outlook had previously attracted both domestic and foreign investment. However, the recent shift in sentiment highlights the market's susceptibility to global and domestic pressures. The following sections will delve deeper into the specific global and domestic factors contributing to this decline. Understanding these factors is crucial for investors to navigate the current market volatility and make informed decisions. The Indian stock market does not operate in isolation. Global events have a significant impact on its performance. Several global factors are contributing to the recent downturn. First, rising bond yields in the United States are creating a ripple effect across global markets. As bond yields in the US rise, they become more attractive to investors seeking safe haven assets. This leads to a shift of funds away from emerging markets like India, putting downward pressure on stock prices. Furthermore, the US dollar has been strengthening, making investments in dollar-denominated assets more appealing. This strengthening dollar makes imports more expensive for India, potentially impacting the country's trade balance. Adding to these concerns are the new US tariffs on steel and aluminum. These protectionist measures threaten to trigger a global trade war, which could have negative consequences for export-oriented economies like India. Lastly, the US Federal Reserve's cautious stance on interest rate cuts is also influencing global market sentiment. The Fed's reluctance to lower rates has raised concerns about the sustainability of global economic growth, making investors more risk-averse. In addition to global headwinds, several domestic challenges are weighing on the Indian stock market. A key concern is the weakening Indian rupee. The rupee has been depreciating against the US dollar, making imports more expensive and potentially fueling inflation. Disappointing corporate earnings are another major factor contributing to the market decline. Several companies across different sectors have reported lower than expected profits, signaling a slowdown in earnings growth. This has made investors question the high valuations of many Indian companies. The persistent selling by foreign institutional investors, FIIs, is further exacerbating the situation. FIIs have been net sellers in the Indian market for several months, pulling out significant amounts of capital. This outflow of foreign funds is putting additional downward pressure on stock prices. Adding to the uncertainty is the new income tax bill. Investors are concerned about the potential for higher taxes on financial securities, which could impact their returns. This uncertainty has led to panic selling and margin calls, further contributing to the market decline. The Indian stock market is currently grappling with a confluence of negative factors, both global and domestic. The combination of rising US bond yields, a strengthening US dollar, global trade tensions, a weakening rupee, disappointing corporate earnings, FII selling, and policy uncertainties has created a bearish sentiment. It is important to remember that stock markets are cyclical. Periods of decline are often followed by periods of growth. While the current downturn may seem concerning, it is crucial for investors to maintain a long-term perspective. Instead of panicking, investors should focus on sound investment principles. This includes conducting thorough research, diversifying their portfolios, and investing in companies with strong fundamentals. By staying informed and adopting a disciplined approach, investors can navigate the volatile waters of the market and potentially benefit from future growth opportunities.